down 19.52% in 2022. Is Clorox an excellent defensive dividend stock to buy for 2023? I'm going to answer that question looking at several different metrics in this video, so stay tuned till the end. The first thing I'm going to look at is revenue growth for Clorox, and you see that explosion, and that was a result of the pandemic when everybody wanted Clorox disinfectant wipes. They were selling these by the truckloads, and revenue exploded over 20% year over year. That's a rarity for a company, a slow growing company like Clorox is. Now it's experiencing some of the headwinds of that. Revenue growth has been negative for several quarters and negative 3.65% in its most recent quarter. And I don't expect it to ever get up to that kind of level again. That was just a rarity because of the pandemic. Next, let's look at Clorox's operating income. And, you know, even if we ignore the peak during the pandemic from the boom, you could see steadily increasing operating profitability, operating profits north of 300 million. So a steady increasing profit. Of course, that exploded during the pandemic, but now that's came down and it's struggling to balance itself, right? And I say this a lot in my videos. In the companies that benefited tremendously from a sales boom during the pandemic are finding difficulty calibrating their business now, right? Clorox is one, Amazon is another, Peloton is another, Home Depot is another. Home Depot is only one out of those four companies that has managed this skillfully and expertly, right? Home Depot has done an incredible job. Its profit has continued to continue to grow despite the major ups and downs from the pandemic fueled boom, right? Clorox, Amazon, Peloton are others that are not experiencing good times following the pandemic. Clorox's profits are below the pre-pandemic levels, right? It's still trying to get back to where it was before the pandemic. Inflation, supply chain disruptions, all of that is contributing to this, and it's not an easy thing to do, right? It's not an easy thing to have your business explode unexpectedly and then fall unexpectedly, right? Without knowing when that's going to happen. Management was unaware how and when sales were going to slow down dramatically, and just as they were unaware sales were going to explode dramatically, this makes it difficult to manage. Nothing against them, and out of all of the companies I follow, like I mentioned, only a very few have shown expert skill in managing this disruption, and Home Depot being one of them. Cash from operations, similar trend, right? Nice upward trend before the outbreak. The outbreak caused a surge, which is now reversing, and Clorox is trying to recover back to its trend line. I expect them to manage this and get back to where they were before the outbreak. However, I don't know if that's going to happen in the next quarter, the next 2, 3, or 4 quarters, but I expect them to figure it out. They've done this before. They've got a history of managing this business well. It's just a matter of calibrating and finding that right balance. And of course, if you're looking at a dividend stock, if you're a passive income investor, you're interested in what the dividend per share is. And for Clorox, this has been very nice growth. Its annual dividend per share was a little over $2.40 in 2014. That has almost doubled to $4.64 in its most recent year. So Clorox has shown very nice dividend per share growth over the last 8 or 9 years or so, and I expect them to continue delivering dividend per share increases over the next 5 to 10 years. They've got a profitable business, good cash flow from operations. They've got some near-term headwinds to be sure, but there's a high probability they figured that out, and then going forward they can return to healthy dividend per share increases. All right, finally, let's look at its valuation to answer if the stock is a buy. Trading at a forward PE of 34.37. It's about the average it has traded for in the last year and a half or so. However, a forward PE of 34 is not cheap, right? The average PE in the S&P 500 right now is around 15 to 17. So a forward PE of 34 is not cheap, especially not cheap when you consider that the company is a slow growing, non it's not going to expect to grow revenue at anywhere near 10% over the next 3, 5, 10 years, right? So you don't want to pay a premium valuation for a company that's not going to be growing earnings very quickly over that time, right? These kinds of premium valuations I reserve for companies that are growing their earnings per share robustly, at least 8%. I want to say I would, however, look for more 12, 13% earnings per share growth if I'm looking to pay this kind of premium valuation. So to answer the question, is Clorox an excellent defensive dividend stock to buy right now? I'm going to say no. All right, that's all I've got for this video. Thank you for tuning in, and I'll see you next time. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.